commercial banking, Warren brings deep expertise across everything from SBA lending to M&A and commercial real estate and ESOP purchases. A former small business owner turned trusted advisor, he knows firsthand what it takes to grow finance and protect a business. Based in the Pacific Northwest, Warren partners with companies to craft strategic growth plans that turn bold visions into reality. No banker speak required. I think that was added by ChatGPT.
Thank you, ChatGPT.
That's right. Okay. All right. Kendall Shelton brings 16 years of hands-on experience to commercial banking, lending, and relationship management. He started as a bank teller and now serves as VP and commercial relationship manager at Umpqua Bank. Really, he's a genuine love for learning what drives people, and he helps business owners streamline their finances and build towards their biggest goals. He was also named United Way's 2023 Young Professional of the Year, and he's a proud community advocate and volunteer with a heart for creating lasting impact. So this is going to be the two people sharing on our panel today, but I do want to talk a little bit about Executive Allies and what we do and what we provide for members of the construction industry. So Executive Allies is a fractional CFO company that provides CFO and controller services to businesses that just need that help. They might not have quite a need yet for a full-time CFO or a full-time controller, but they need a more elevated look at their financial situation. So we're based in Boise, and we have a really strong team that supports all of our clients. So I'm Sharon Popple, and I'll be moderating this conversation today. And we'd love for there to be audience interaction. So if you have questions as we go, please feel free to raise your hand and we'll get those answered. Okay, thanks. Okay. All right. Okay. So I'm sure with everybody paying attention to the latest change in government and changes coming down the pike, I thought we would start with talking about the trends that we're seeing in banking and lending, particularly in the construction space, and what business owners should be paying attention to in the coming year or years to come.
I guess we'll get started here. We're seeing a lot of changes going on. Honestly, some days it's kind of difficult to keep up, especially on the tariff front. We try to tackle that as best as possible, but it changes daily. I mean, I just saw on the news this morning that Trump's, the 25% tariffs on automobiles. So what's that going to do to the construction industry? Obviously, we get a lot of vehicles and so forth. Construction companies need vehicles. Hopefully, they're buying domestically. So it won't have much, shouldn't have too much impact. But if we just recently financed some cranes and trailers and stuff that came out of Canada. So what's that going to look like? Obviously the cost structure is going to change drastically. So it's hard to manage, and it's hard to help our clients manage through that when it's changing daily. I think what we're seeing is just a lot of customers are kind of wait and see a little bit to see how this is all going to shake out, because it's all relatively new, it's happening fast, and it's changing day by day. So what do? A lot of people are just kind of pulling back until they can see kind of what's going to shake out. In terms of, so on tariffs, I mean, that's probably a whole panel's worth of discussion, I think, in political change. But we're just trying to help our clients manage through a changing environment. Interest rates, another hot topic right now. Rates have kind of been coming down. They kind of go up. They change daily. We always are asked, what's the forecast for interest rates? And it's a crystal ball. It's anyone's guess. They kind of come down for a little bit, and then the market reacts, and then they shoot right back up. But overall, the Fed's saying rates should come down, maybe 0.25% or so, but nothing drastic. I don't think we're going to see any major changes this year. I think it's maybe down the road, maybe out, beyond that kind of that 12-month mark. So a lot happening on the forefront. We just try to. I think the best thing that we can tell our clients is just work with your banker. Talk with them on a regular basis, try to stay in front of all the changes that are happening. We too are just inundated with data, so we try to get through it, manage it, and understand it, and then help our clients through it as best as possible. So I guess there's a few things I'll turn it over to.
I just kind of to add on to that, I think some of the things we've seen, like in the banking industry specifically, as far as how banks are kind of looking at things, how they're managing things, I would say there's been a big shift with all the weird rate changes that have happened over the last few years, where I think banks are just really focusing on that relationship specifically. So sometimes whenever you're going to work with a bank, it's not really about the transaction anymore, especially us at Umpqua. It's more about, okay, so what does the full relationship look like? How does that, and kind of mitigating things and working with clients around what the relationship actually is. Big focus for banks on deposits, for capital, for things like that. And then I have my notes and then my phone locks up. And uncertainty, in the market, there's a lot of uncertainty out there. Like Warren was saying, we're seeing people pull back, we're seeing people look at things differently. And so I think with uncertainty, typically in banking, means we got to make sure that, we are doing the right thing when it comes to lending, that we are very, I would say a lot of banks have gotten very conservative in a lot of ways in how they're doing lending. They're just being a little bit more specific on different things in financials and different how companies are managing change and how companies are managing the different increases in supply costs and things like that. I would just say those have been really big focuses and kind of big changes, I would say, in the banking specifically.
Kind of follow up on, Warren, you had said a lot of companies are seeing them taking like a wait and see stance there. What would you say are actions that construction companies in particular can take rather than just like pulling back and waiting and seeing? What can they do to proactively be prepared for, a downturn or even a potential increase in housing? Like I know when COVID hit, my personal instinct was like, oh, nobody's gonna buy houses right now, nobody's gonna do anything. But then all of a sudden there was this huge boom. And so in that uncertainty, what can owners do to take action rather than just wait and see?
Excellent. Yeah, good questions. I'll try to touch on all of them. If I miss something, definitely let me know. But I think the most important, and you're going to hear me say this quite a bit, is just know your banker and have a good conversation, a good relationship with your banker, because hopefully we can help you kind of stay in front of all these changes that are happening. It's better to build a relationship with a banker and have a good quality banker on your team when times are good. So when the market changes, when your financials maybe don't look as good, your profitability maybe is deteriorating, that's a hard time to get involved with a solid banking relationship. And maybe if it's a brand new relationship, maybe that bank's not going to be willing to take a little bit more heightened risk with you. Versus if you have a long-term established banking relationship, hopefully we would like to weather through those storms with you. So I think just having a better understanding of your banker, develop that relationship early on, so in times of need, then you can reach out to your banker and you're going to get that information from your banker.
So I know that as a banker, you know what you mean when you say banking relationship. Some people might not know what that means, and so when you're evaluating a banking relationship or when you talk about a banking relationship, are you meaning like that is going to be like we're going to go golfing together or stuff like that, or what does that look like?
I mean, hopefully we are, I like that part.
Okay. All right, remember it's not deductible. Okay, but what should owners look for, and what would, if they're evaluating their bank relationship as it stands right now, what would you say they should look for as red flags or green flags when they're evaluating that?
Yeah, I think partially it's about, especially when you're evaluating a banking relationship and looking where you want to be banking, it's knowing the bank that you're looking at. Evaluate the bank, talk to the bankers, understand what the bank's credit appetite might be. So different banks really focus on different industries and different things, and understanding where their interest is and the kind of companies that they want to work with is pivotal, because you want to make sure that your business fits with that bank's appetite and what that bank wants to work with. I think understanding resources that are available at the bank. You don't ever want to get involved in a situation where maybe a bank is too big for your needs, where you kind of get lost in the numbers, or if your bank is maybe too small for what your needs are, then you could potentially be outgrowing what you need from a bank. And then really having kind of what technology you want to have involved in your business. I mean, are you guys wanting to have, remote wires, remote deposit capture? Do you want to have ACH capabilities? Do you want to have commercial? There's different aspects in banking that all kind of tie into the relationship that you want to make sure is available if it's something that you want. And then knowing your banker, I mean, we can't probably hit that hard enough. Yeah, seriously. Because knowing your banker really comes down to the fact of having a relationship with that person, and so that the banker can understand your business, you can understand the banker and the bank and how they work, because you want to make sure that's a good symbiotic relationship where you can really provide value for each other. It has to work both ways. It can't be just for the bank, it can't be just for the customer. But because ultimately when it comes down to it, when we're looking at credit and when we're looking at lending and when we're looking at a relationship all in, it really comes from the fact that your banker has to be your advocate. Because ultimately there's going to be people that are approving the deal, there's going to be different people involved in the relationship outside of that really the banker kind of works with to make sure everything gets implemented and done right. And so being able to have that banker understand your business enough to be able to be the advocate for you so that they can properly explain what's going on, especially when it comes to if you have weird things in your business like a lot of seasonality, or if you have long sales cycles, if you have things like that, having a banker relationship who understands those things can be really key in getting things done as well.
I was just going to add just the quality of financial statements. We see this too much, and unfortunately, the smaller the company, the more we see it before they kind of get their financial house in order. But having good quality financial statements, sitting down with a CPA on a regular basis, they should be one of your trusted advisors. Should have a good attorney, a good CPA, a good banker, among others. But someone like Sharon, the executive ILIs, sit down with a regular basis. Don't just go to them, at tax time, one time a year, to prepare tax returns. Go to them on a regular basis and get your financial statements in order. So then when you do need to borrow money, the financials, they reconcile, the balance sheet actually balances. The retained earnings, reconciles from year to year. There's not a big gaps in data and so forth. So have that kind of financial house in order, if you will, before you need to go borrow a bunch of money from a bank or before you need that line of credit, because it'll make the banker's job a lot easier. It'll make your conversations go a lot smoother and more worthwhile. And quite honestly, the loan approval process goes a lot quicker if we can quickly get behind the numbers and then really see what your guys' vision is. So I can't emphasize that enough. Just have a good banker, a good CPA, but also get your financial in order kind of before you need to. So
When I think about banking relationships, I think about exactly what they're saying, and we have a lot of opportunities that we have conversations with clients where there's a banking need or a banking change that they're looking for, and the right size is always what we're looking for. So we have small clients that are local to Boise, and so we try to refer them to local banks. If we have a company that's expanding regionally, then we try to look for regional banks. If we have a company that is nationwide, they have a lot of contracts in international companies, that's when we start thinking, okay, we probably need somebody that's a little bit better on the foreign side. Then we start talking about national banks. And so keeping it the right size, I think, makes a lot of sense. And then understanding that technology piece too, like what are the needs that you have in your business that are going to be looking towards those more advanced, technologically capable things? Does it integrate with the things that you needed to integrate with? So all super great points. Okay, so right now, we talked a little about this earlier, how we're positioning ourselves to be ready for the next downturn. So when we think about growth opportunities, like right now we're all thinking about, okay, hunkering down, but when we see growth opportunities, what kind of trends are you seeing companies take when they're trying to mitigate that next change?
I think one thing that's very important for companies to kind of do as they're looking at this and as they're planning is just having a really good team of advisors kind of surrounding that company. Because, I mean, at the end of the day, it's like people open in businesses typically because they're really good at whatever they do, right? They're the best at what they do. So then they open in a company to do that thing. But there's so many other things that go along with running a business, right? There's the financial component, there's insurance, there's legal, the list could go on and on. So making sure you have things like a good CPA in your team, I guess, Having a good accountant, they are two different things. I would like to say that. It's always good to have two different people to do those things. Having a good banker, having a good insurance agent who understands your business, HR if you need it. There's also attorneys are huge. You know, as we're looking at, you know, it's nice when times are good because it's easy to do bids, it's easy to get things out there, but how do you mitigate things? Attorneys can help a lot with contract mitigation, things like tariffs, right? Being able to make sure you have like escalation clauses, that you're bidding things right, that you're having your stuff put together so that you can be prepared for if those things hit. But also, I mean, ultimately cash is king, let's be honest. And so whenever times get bad, having a good reserve of cash is really important for businesses. You know, I know that sometimes people say 60 to 90 days usually of your operating expenses. I would say probably 90 to 120 days. But just having that cash available, so if you do have a job that goes bad or you have something that doesn't work, that you have those reserves to kind of back up on and kind of make up for that so that you can go to the next job, right? And get the margins that you were supposed to get on the first one if it went sideways.
Perfect. Well said. Just a few things to add. Maybe just operational efficiency. You know, to kind of prepare for that growth. So ahead of time, you know, is your balance sheet in good shape? Are you collecting your receivables on a timely manner? Are you paying your payables? You know, is that cash cycle as quick as it can be? So you're returning that cash back into, you know, liquidity so that you can prepare for the growth. You know, on the income statement, is your revenues, are they solid revenues? But then also, are your margins good? Are you controlling your costs to make sure that your net profit is solid? Because, you know, profitability leads to profit retention, which leads to liquidity, hopefully. And so if you have that liquidity, or at least a line of credit to support that growth, you know, so when that growth does come, you have the availability to, hey, yeah, this growth is going to create a bunch of receivables, which is going to take a little time to collect, therefore it's going to use up all my cash. You know, growth is expensive, growth costs money, but hopefully if you do it right, growth's going to yield, you know, returns, net income, and liquidity, and future growth. So I think the main thing is just trying to, operational efficiency, are you working well? During the good times, are you still managing your expenses? Because when the downturn comes, if it comes, have you already kind of pared back? Are you already running lean and mean? Or is there a lot of additional expenses in there that all of a sudden, oh, now I got to go cut a bunch of people to get my payroll down because, you know, my revenues are down. So hopefully you can kind of plan for the worst and not get, I hate to say it this way, but don't get too fat during the good times and that you have to really lean down in the poor times, you know what I mean? So I think organizations can do that. It's easy to kind of let things slide a little bit when things are going well, but the more I think you can keep a focus on your balance sheet, your financials, and it all goes back to good record keeping, and then you're looking at your financials and working with your in-house people as well as external experts to really understand what's going on in these numbers. Those financial statements are important. They'll tell you what's going on with your company if you know how to interpret them. And having a good team, if you don't have that expertise, have a good team with you that can understand that, explain that, point out the trends, and then help you guys position for that future growth.
Okay, so on that, thinking about growth, I heard Warren talk a lot about controlling costs. One thing that I don't think business owners always think about is the pricing. And so right now we're in a position where there's been so much inflation and so much growth in costs overall, and the labor market is being more expensive. And so making sure that there's an evaluation process that happens at least annually of what you're charging, and put it into your process that you're increasing your rates at, you know, a rate of 3% or 4% or whatever that is every year, to make sure that you're keeping up not only with the raises that you're giving your team, but the cost increases that you're seeing across the board with everything that's coming through. So that's the first thing that came to mind when I was thinking about that. But then the other thing is flexibility. So hiring people, that's a long-term commitment. When you are looking to hire people like full-time or even on your staff, that's somebody that is on your expectation team of, they're expecting you to provide them a paycheck every month, every 2 weeks, whatever that looks like. But there's other options out there. So I forget the gentleman's name with tradesmen. Oh. So outsourcing labor or using like more flexible labor that you can kind of ebb and flow. And so when you have really heavy months of increased revenue, you can use that resource, and it might be a little bit more expensive, but you're not having to make that decision of letting somebody go at the end of that job and affecting their livelihood. So the other thing too, ProTrade bookkeeping is here as well. So bringing in some of these outsourced resources that are not necessarily a full-time person on your payroll, that you have to increase your FTE count. So just being thoughtful about that. There's fractional pieces in everything that we do, and so these companies that are growing above $1 million and pushing towards $20 million, you might not have a need for a full-time marketer or a full-time HR person, but leveraging these options that are out in the market might be a really good option, especially as we're kind of like in this period of uncertainty, which I feel like we've been in forever, but leveraging the resources that we can, I think, is really helpful. I mean,
Thank you.
or executive allies too, right? Okay, all right. Okay, so when we're talking about cash, that's obviously king, but now construction industry is one of those industries where you have to have heavy equipment. You have to have these big pieces of machinery to do the job. So when you talk about cash reserves, how are you advising clients on cash reserves versus debt? What does that look like?
So I think cash reserves are great, but they're kind of should be like more of an emergency fund, right? We always advise people like have those cash reserves when you need them, for when you need to. But ultimately, like I think for a sales cycle and for working through jobs and things like that, I think a line of credit is needed for most construction companies, just because there's so much you have to outlay in the beginning. There's so much you have to do during the time as far as expenses before you ever get paid. And so having a line of credit and being able to kind of help you fund that gap that's needed between collecting on your ARs and while you're still paying on your accounts payable and things like that, so you're staying current and all that. The reserves, I would say, just hold those in the back for if you need them, but keep that line of credit safe. The other thing too is I know that sometimes when times are good, which it's been really busy in the construction industry over the last couple of years, right? People are doing well. There's a lot of opportunity. But I think that you get used to when the times are good. You don't think about when you're actually going to maybe need that line of credit because maybe you can cash flow it and it's worked great. But when the time comes that you need a line of credit, sometimes it can be hard to get it when you need it. It's easier to get it when you don't need it. From a banking perspective. So I would say get it in anticipation of those times to make sure that you have that flexibility if it comes up, but don't necessarily just use it for everything, right? You need to be able to just have that there just in case. The other thing is like equipment finance is a really big one that we see for construction. And I would say, for us, I know the way that we look at equipment in a lot of ways is we want to make sure that when you guys buy that piece of equipment, right, it's not always, you don't always necessarily want to do it the easiest way possible. You want to do it the way that makes the most sense, right? So you want to pay attention to, how long am I going to be keeping this piece of equipment? Are the terms matching, how long I'm thinking this useful life of this equipment's going to be? If you think that you're going to turn this thing and sell the piece of equipment in 4 years, but you have a term that's 6, 7, 8 years, then potentially when you try to turn and sell it, you're going to have to write a big check to the bank because it's depreciated past, what you're able to get out of it. So you don't want to have that situation pop up. You want to make sure that that equipment is paid down enough to where whenever you do sell it or whenever it's ended its life, that you're able to actually capitalize on that piece. I don't know, do you have anything else you want to say to that, or?
I think you did a nice job, Kendall, covering that, but I think maybe just a couple things to add. On terms of the line of credit, think about a sweep account. A lot of people will maintain good cash balances, have $500,000 over here, but they also have a balance on their line of credit. Think about a sweep product. Basically, if you don't understand a sweep product, it just moves money overnight for you. So instead of all that money sitting in a checking account, we're not paying a whole lot of interest rate on regular checking accounts, or there's not much interest rate right there. Versus what you're paying on a line of credit. So have that money work for you every night. It sweeps those funds over and pays down your line of credit. As soon as you write a check and need that capital, then it advances back. So take advantage of some of that technology that banks have to kind of help your money work for you. maintain as much liquidity as you can, but also it makes sense to put some of that to use. I think Kendall was touching on just trying to match up the useful life of the asset. I have a lot of customers that in construction industry that make good money, and then they have a tax problem to deal with. What do? They go out and buy a bunch of equipment, Section 179, I got depreciation, fully write-off. Okay, I just drained all my cash. Okay, time slow down for a couple months. Oh shoot, now I'm strapped for cash. Well, if you would have put that out on equipment note, put it out for 2, 3, 5 years. If the useful life's 10, maybe put it out for 5 years. Make sure there's no prepayment penalties. So if you have extra cash, you can kind of pay that down, but it doesn't tie up your cash. So it kind of helps, a line of credit can help smooth out your cash flow cycle is what I'm trying to say. So yeah, when times are good, you're flush with cash, and then times slow down just a little bit. Or, construction industry is notorious for, receivables on contracts. You guys do the work, you're the employee, the cost, you got the equipment cost, all this jazz. That you're putting into this project, but especially governmental jobs, you're not getting paid for 60, 90, 120 days. So it takes time for that cash to come back in to be utilized. So a line of credit can help kind of smooth that out. So that's one thing I just wanted to add.
The thing that I know has been really helpful to a lot of the companies that we work with is we'll prepare a 13-week lookout of your cash. And so that will help give them an idea of like, hey, if we do this, if we take this loan or we get this line of credit, here's what this is going to look like, or here's what our cash is going to look like over the next 13 weeks. And so then we have an awareness, maybe a month or two ahead of time, of when that draw might need to be. And then maybe we can take that time ahead of time to call some of those customers that we've been working with and say, hey, that invoice that we sent, we're just following up on the timing. Because sometimes the squeaky wheel gets the grease, and sometimes there are other extenuating circumstances where there's really not a lot of option in getting paid sooner. But maybe you can hold on to an invoice that you're paying out a little bit longer to extend that cash flow a little bit longer. So when a person is coming into a banking relationship, or they're starting to court a banker, I think of it as a date. And so of course I'm thinking like, okay, what do I need to do to look really good to come into this evaluation? And so of course I'm thinking like, I gotta get my financial statements, I gotta know what I'm talking about. When people come into that first conversation with you, what financial statements should they be bringing? And what questions are you guys gonna ask in that first meeting?
Either way, I think the first, you don't have to bring a full financial package. Those days, I remember back in the days where they bring a 3-ring binder. I know I'm really old, but bring a 3-ring binder of all the financials, tax returns, personal financial statement. It was great. It's like, oh my gosh, half the work's done, I feel like. But nowadays, technology and everything, we just like to have that first meeting, find out what you're looking for, what's your interest, what's your business all about. Just kind of have that informal, casual conversation. And then we're happy to put together a needs list of what we'll need. There's a standard, 3 years financials, tax returns, that sort of stuff. But depending on where that conversation goes and what your needs are, we're going to kind of tailor that list in terms of what we're going to like to see from you and your company. So I think just have that initial conversation, get to know your banker, see if it's a good fit. It is like dating. It's like, is it going to be a match? Because hopefully you have a good relationship with your banker and a regular communication, rather than just meeting with your CPA once a year, your banker once a year, whatever, when you need it. It's better to have that ongoing relationship. So
No, that's good, because I think every banker does things a little bit differently, right? And so, but I would totally agree with Lauren that it's like, I would say 9 times out of 10 when we first meet with a brand new potential client or whatever we're looking at, I don't think I ever really talk about products, solutions, anything like that. All of it is questions, right? It's just understanding hey, is this going to be a good relationship? What are the needs? What's keeping you up at night? What are things that we can help out with? Because I think that is the most important thing, is understanding that piece. Because also it's, bankers have to work pretty, when you're giving all your financials and everything up to a banker, that's really private information, and that's stuff that people don't like sharing all the time. So building trust and having that with your banker is important. I think sometimes it's just about, part of that relationship piece is this somebody I'm going to work well with, right? That's a big deal. Is this somebody I can get along with and can actually work with, or is this, they don't see eye to eye with me, this is not going to be a good fit, and that's okay. Personalities are different, that's understandable. Warren and I work relatively sometimes differently, sometimes the same, but there's a lot of bankers out there, and there's a lot of good bankers, and being able to have that person that you can trust and work well with is probably the biggest piece, because there has to be that really good symbiotic relationship there. But yeah.
I think that's one thing that I've been really impressed with this community overall, is that the bankers actually work really well together. So typically when we refer out clients to banks, we don't just refer them to one bank, we refer a few different banks. And so we typically encourage our clients to check out Umpqua, check out Hillcrest, check out these other options in the community. And I found that they're really upfront, like, hey, this is gonna work or this is not gonna work. And even if both people say we have options for you, one might be better than the other, or that relationship piece might be there where it wasn't with the other one. And so it's really good to play the field a little bit, like.
It's date around.
Yeah, but make sure that it is a good fit, because if you're gonna build a relationship that you want to be effective for you in the future, you want it to be a good fit. And so make sure that you do your research and talk to multiple people. And bankers are really great resources for other bankers, which is the weirdest thing.
I was going to add that some of my best referrals are from other bankers. Some banks
They're just not a good fit. Their portfolio is full of a certain type of loans, or they have too much concentration in certain areas. So some of my best referrals are from other bankers. Just like it doesn't fit us. I'll hopefully refer it over to John or some other bankers. So it's not always a good fit, but hopefully we can. If we hear your story, understand your company, and can make the best recommendation, and hopefully we have something that fits your guys' need, then it's a win-win for everyone. If not, we're happy to hand it off to another banker and say, hey, it's not going to be a good fit here, but maybe a revolving loan fund, or maybe USDA, BNI. There's so many other loan programs out there. And I have a lot of people come to me and it's like, hey, so what loan program do I need? Well, tell me your story. Tell me what you're trying to accomplish. Tell me what cash you have to work with, down payment, and then let us kind of tailor that loan product for you. And if it's not a good fit for us, hey, let me refer you over to the Small Business Development Center to build out a business plan. Let me refer you to Region 4 for revolving loan funds and SBA products. So there's tons of resources out there, and it's our job to figure out those resources for you based on what your guys' needs are.
That's awesome, and you guys are awesome. So other than like banking, we've been talking a lot about banking and dollars and cents, and we get really excited about that. But what other trends are we seeing in the construction industry?
From what I've heard, it was kind of a slow start to the year in a lot of ways. But I heard bidding just went crazy in first quarter. There was a ton of bidding out there. There was a ton of availability of bids, but then it's also getting that stuff to actually working on jobs. I think, I would say that something we've seen across some of the clients that we work with would be margin management. So it's really making sure that when you're bidding things in a way that it's the right price, that you're getting what you need out of it, that you're taking a really good hard look at like what your costs are going to be, that you understand those things, that there's not going to be a lot of fluctuation. I think also, you mentioned tariffs. I know that's big. It's been a big conversation. Like I just joined. There's a National Utility Contractors Association that just started up here in Southern Idaho, and they actually just sent out something that was really cool last week. That was approved by their attorneys. That's being looked at nationally. It's how do we put things in our contracts to be able to mitigate some of these rising costs, like putting escalation clauses based on, if there's government regulation that causes our supplies to go crazy, that we have those things in there. There's also a lot of stuff like, I would say real estate issues has been really big here in the Valley specifically. And when I say that, I think that's more because contractors have equipment, right? There's a lot of equipment. You need to store it somewhere when it's not on a job site. And there's only so much land. And land here is getting expensive, and office space and industrial space is getting expensive. So being able to kind of have, add to your team a commercial real estate broker, who can kind of work with you to understand your business needs too. So if something does come up, or something makes sense that would help you as you're growing or expanding, or if you need more space, being able to kind of have those opportunities easily accessible is a big deal. Because land is getting gobbled up for sure, with all these developments that are going on. I think having stuff accessible in an area that's easy to get on and off of the freeway, easily to get to your job sites. I mean, I've seen that getting harder and harder to come by. But
I was just going to add what I'm kind of seeing. I would say at least 50% of my portfolio is contractors and subcontractors, with ties to construction. Most of them are doing pretty darn well. Most of them have a full backlog in front of them. They have work in front of them, lots of projects. But I think it's just kind of preparing for what if, if interest rates, continue to climb, the economy slows down, things like the Micron project, for some reason that Micron project doesn't get fully funded. Think of all the contractors that are out there on site now. If that falls apart, if that, turns a different direction, that's going to change the economic activity in this valley quite a bit. So I know a lot are dependent on that. So I think just kind of try to be prepared for what may happen. You can't live under a rock. You can't not do business, but you also kind of have to think of what's might be happening in the future. I was going in a different direction too as well, but I lose my train of thought. So I guess that's all I got to say about that for now.
All right, well, Warren grabbed some more coffee to keep his train up. I really liked what you were talking about with the bidding and seeing the influx of bidding right now. When you think about bidding and pricing, what do you see from a percentage? How frequently are people winning bids? Do you guys have any insight into that, or is that something that even the construction teams that you work with have insight into? Like, how many bids are they winning out of 10?
that's probably a better question for all you guys.
Yeah, that's probably a better question for you guys.
Yeah.
I feel like a lot of our contractors are winning bids. It's really interesting that some general contractors, their margin is extremely compressed, and then you get to some of the subcontractors and they have really significant margins. So we're seeing margins, like I can't really say, 5% or 10% is the average margin, because I know some people are making 50% margin, gross margin, other ones are barely squeaking by about 5 or 6%. So it really just depends on the contracts you're working with, who the industries, the subcontractor, the line of business, if it's kind of specialized, or is there a lot of competitive pressures? Are there a lot of other companies in town that are doing the exact same work or similar work? Or do you kind of have a niche of what you do, the products and services that you offer that no one else can touch? Are there barriers to entry and that sort of thing? So margin can be all over the board. So I don't know if we can just generalize, say, this is what we're seeing. But in terms of winning bids and so forth, it's competitive for sure. Depends on what you're bidding on. Multifamily was super competitive, but I think there's a lot of general contractors that are like, okay, everyone's full of multifamily. Let's shift to light industrial or some of these other asset classes. So, but overall, I feel like our economy still is doing pretty well. I know Corey Jacobson's in our group. He's our divisional leader, and he sees a lot of other different markets as well. And he's more conservative than I am, because he's starting to see some weaknesses in other markets that I don't really feel like we're seeing too much in Boise. But I also don't want to get to the point where, Boise's golden, we're recession proof, because we've seen the downturns as well. It just tends to see, in my career at least, it seems to be that Boise kind of trends a little bit behind some of the other markets, especially like Seattle's and Portland's and stuff like that. And I think we're pretty well insulated. I feel like, we got Micron, we got semiconductors, we got technology, but we also have construction, we also have hospitality. We have a lot of people moving here still that need, consumer services and so forth. So overall, I feel like our economy is pretty darn solid, but I also don't want to be asleep at the wheel too and be surprised when everything kind of slows down.
One thing I'd just add on to that is, talking with some GCs out there, I've heard that there are some subs, and I've heard this from some subs also, where there are people that are just coming in super low just to get a job. And I would really encourage not to just try and win the job. Make sure it's a job that's going to work for you when you're bidding. It's sometimes better to say no. I would say that. More revenue doesn't always mean more profit. If you're not watching that kind of stuff. I think that's been really important in the bidding process because I know that they're, after the last couple of years, right? Like there's a ton of people that are like, oh man, I see the construction industry's going crazy. I'm gonna open my own business too, which is great, and we want to see that. We want to see that economic development, but sometimes when it's like a one-person shop, and they're just going out and doing the job themselves, they can bid stuff a lot lower, right? Than maybe if you're a little bit of a bigger business that has different teams or different crews that your overhead might be a little bit more and it just doesn't work. Don't just try to beat that guy to get a job. The other thing too, I think that goes a long way though, when you're doing bidding is have a good relationship with the GCs out there. I know that GCs really appreciate when they have a sub that they know and that they can trust. They will give preference to subs that they know that will do the job right. And if you have that relationship there, that's a huge deal when you're doing bidding in your chance of winning a deal.
Yeah, relationships over everything, almost. Yeah. But some of the margin talk that was coming up, knowing what those margins are is first and foremost what you need to know. If you have no idea if you're going to make money on a job or not, then, you could be finishing that job in a year and coming out losing money. And if that's the case, then you're going to quickly go out of business. I had one, I think it was a manufacturing company that I was talking to, and he was telling me that his methodology for bidding, he said, if I'm not losing at least 30-40% of my bids, I'm not bidding high enough. So my margins could be higher if I'm not losing at least 30-40% of my bids that I'm quoting. And so understanding those numbers and tracking those numbers, I think is really important to have an understanding of like, okay, we sent out 100 bids last year and we won 70 of them. So that's a reasonable thing to track. Same thing on your margins, like what should be included in your direct costs going into your jobs? Should it be your office administrator? Well, probably not. But your foreman? Yes. So understanding what needs to go into those dollars there matters. Okay, so looking ahead into the next 3 to 5 years, and we've got maybe 15 more minutes of conversation, but when we're looking ahead in that time period, what are practical steps that can be taken right now to prepare?
Yeah, I think having reserves on hand, I know I already said it once, but I think that's really key, making sure you're prepared for when things are not so great. And if you don't need it, that's great. That's awesome. Hopefully that's the way that it is. But just being prepared for when times are not so good, or if you're kind of starting to see some kind of downturn in that. I think making sure you're utilizing the team of advisors that you set up around yourself, making sure you have those people, that they have your back and that you're meeting with them regularly so they can kind of speak into things that might be helpful with the business. Or, when you're in the business every day, it's kind of like, I feel like when you're in your house, every single day and you see that same thing over and over and over, you might not think about it as much as somebody else who comes in and sees it for the first time. They're like, oh, what is that? Because it's not, they're not living and breathing your business every day, and they might be able to bring in a different perspective or see things a little bit differently. So I think having that team of advisors around you can really help you kind of prepare for the future. And I know she said 3 to 5 years. I honestly kind of tell people a little bit 10 years too. Like, understand where you want your business to be in the long run also, not just 5 years out, but where do you want to be in 10 years? Do you see yourself exiting your business or selling it, or do you see yourself still continuing on strong? Where do you want to see how big your business gets? Having people like exit planning folks or people who can kind of come in and do advisory work and evaluate your business and kind of help plan for that stuff is really important too. And also, like, I would say this, one thing that I've noticed really great about the subcontractor community specifically, and being the subcontractor association, is that our community here of contractors is really great. They are amazing at not being they're competitive with each other, right? You want to win jobs, but they're also open to having conversations and helping each other out. And I say, like, surround yourself with peers too. Understand what they're seeing, understand what's going on in their community as well. See where maybe they're seeing things that maybe you aren't. But I think surrounding yourself with peers that do similar things as you is super important also, just so that you're not overlooking things.
I don't know if there's anything left to cover. Well done. I was just going to add, if you're looking out 3 to 5 years, how to kind of plan for the future. Again, it kind of goes, I think, it goes a lot back to your balance sheet. Make sure you have low leverage. If you're levered up during the good times and then things slow down, it just doesn't provide you with enough flexibility versus if you can kind of pay down that debt and clean up that balance sheet, get in good, strong financial condition. I think that helps you weather through the storms. And we see it a lot where, they have way too much leverage going into that downtime. Revenues kind of fall off. You got to lay off people to trim costs to get your profitability back in line. Meanwhile, you're still carrying all that debt and all the debt payments and so forth. So try to take care of that during the good times instead of buying new boats and new toys and new equipment. Maybe pay down some debt so that you're operationally you're fit. You're ready for those lean times. So diversify revenues. I can't say this enough. Just like Kendall and Sharon were saying about revenues, when you're bidding on projects, is that good quality work that you really want to be doing, or are you just trying to win the job just so you can keep your guys busy? Because if you're trying to keep you guys busy, it's extremely low margin, and I'll pick it up with change orders. The person running the project or developer, they don't like those change orders because they worked in their budget. Hey, this is what we plan on spending, and now you're hitting me with a bunch of change orders to try to get your profitability back. No one likes that game. So try to diversify your revenues. Just make sure you're going into projects that make sense for you. You're going to make your company money, not just keep your guys busy, and then everyone's happy at the end of the day. Quality of customers. Make sure if you're going after the right type of work. Are you just getting into a relationship just to get the next job and keep your guys busy, or is it good quality work that you can be proud of, put your name on, because it's going to be out there in our market, our small community, like so-and-so did this project. Well, it was flooded with change orders, cost overruns, the project took 10 times longer than it should have. Does that the kind of reputation you want? Or you want to go focus on maybe fewer jobs, but higher quality jobs? So I think just kind of diversify. Don't have all your eggs in one basket. So if the market does slow down, if you're doing all government work and all of a sudden that governmental funding slows down, do you also have that private sector work? So I think just try to diversify. That will help you kind of plan and anticipate if things do slow down the next 3 to 5 years. And I think that was it. Just wanted to kind of add that.
Yeah. All super good points. I would say contrary to diversification, what we've seen in some of the companies that we work with is a furthering of their niche. So identifying what is most profitable for them and then saying, okay, what do we have on our table for equipment? What do we have here? And what do we need to keep in order to continue doing what is making us the most money? And so can we sell off some of this equipment? So reducing some of those leverage points. So when we talk about leverage, that's going to be like, how able are you to pay your bills and how much debt are you leveraging to keep your business afloat? So thinking about some of that, and then also as you're expanding and growing, maybe renting equipment for a small period of time to see like, okay, is this something that is truly going to be worth an investment of a $300,000 new piece of equipment? Or is it something that we can rent for a little bit and see when that break-even point is going to come? Because again, having these commitments, when we hire people, when we buy an asset, those are long-term commitments. So what are these shorter, maybe less or more expensive options that we can take from, using some short-term labor options or some rent options on the equipment side, or some outsourcing of these higher level skills that we need in HR, marketing, CFO work and stuff like that, that could be turned off should the worst economy happen. Then it's not letting go of people, it's not having to sell your equipment in a fire sale. You're making these smart decisions that are as flexible as possible.
If I can just add,
yeah.
That's a valid point, because we get a lot of people that come in and, hey, maybe I need to buy a $1 million piece of equipment, but I don't have all the work lined up, but I think I can go get the work, versus someone that's, hey, I've been renting this piece of equipment for the last 6 months. I have 18 months worth of work in front of me. I know what the margin is on this profit, and we can replace that rent cost and we can add it back to the cash flow and convert that to a loan payment. As long as that work's there, it's already established, it's profitable work, you're doing the work, versus I'm currently focused here, but I want to go this direction, and it's more risk for the bank to take on. So just wanted to add that.
Yeah. The other point that I would say too is keeping track of your targets and your metrics, like having a couple data points that you're looking to on a regular basis that you can see, are we performing where we thought we would be performing? I had a client reach out to me a couple days ago and they're like, hey, we need an urgent meeting. We've got to address this issue because they have a target of $20 million that they want to hit for this coming year. And they're like, we're 2 months into the year and we are not on track, so we got to get this together. We got to figure out what we need to change. We got to figure out what we need to do. We got to figure out why we're hesitant to jump into this bidding process even. And so they're kind of evaluating like, okay, we have this problem. We know we're not hitting our goals, but they're keeping track of their numbers closely enough that they have early indicators coming down to them that say, hey, you're not on target. You're not going to hit this goal if you don't change something. And so having that information on a regular basis that you can make a data-based decision is really, really important. Okay, so any last couple thoughts before we open up for questions?
I'd probably just kind of reiterate, like, use your resources. You guys know your businesses best, right? You're gonna know them better than anybody else. And you also know your peers, you know who you're out there with. There are a ton of great resources in this community that allow for open and candid conversations. I mentioned the American Subcontractor Association. It's a fantastic group of great subs that have really good conversations out there about what they have going on in the market. I would also say there's NUCA, so the National Utility Contractor one just opened up. They're getting started. It's been a great group of folks to kind of get together and talk through those things. Also, there's a lot of really good resources out there from a lending perspective also. So just because a bank can't do it doesn't mean that there's not creative resources out there that can help with those things. Everybody knows SBA, right? SBA is they've been huge the last 5 years. But there's USDA if your business is in a rural spot. There's USDA options. There's things like Warren had kind of mentioned. I'll let him talk about it more. But Frontier Community Resources offers alternative lending solutions outside of bank finance. And even Idaho specifically has a collateral support program that is a great program. So if you need help or you don't quite have the ARs, because you get paid too quick, which is a good problem to have, but then you can't get a line of credit, or if you need a little bit additional collateral to kind of make a deal work. Idaho Housing actually provides collateral support to banks to help get loans done, which is a really great resource too. But it kind of goes back to knowing your banker and having a good relationship to make sure that that those creative ideas and that creative tailor fit custom lending can kind of come into place to kind of help bolster what you need.
I was just going to add, just in terms of cost of financing, small businesses, I think the lowest cost is probably a family loan. Mom and dad are getting 2% or 1% on a CD, but I can loan it to my son for 4%. That's probably the lowest cost. Bank financing, I would say, was probably the next lowest cost. We typically try to keep our costs very low. After that, it becomes, SBA loans because of guarantee fees and packaging fees, and then the cost kind of keeps going up from there. Your fintech and your hard money lending and stuff like that is normally your most expensive. Factoring, stuff like that. So, and if you can build that good relationship, I can keep that cost of borrowing as low as possible. Obviously, it moves, especially lines of credits move typically with prime rate. Prime rate's up, so the cost of lending is up. But generally, if you can build that good relationship with a banker and get into that lower cost of capital or lower cost of financing, that's much better than going to a hard money at the last minute and paying 12, 15, 25%. So just wanted to add that. There are plenty of resources, and don't feel like you guys have to be completely knowledgeable about all the different USDA programs or the revolving loan fund programs. Just build that good relationship with your banker. They hopefully understand that. If they don't, go find another banker probably, because they should. But there are a lot of really good bankers in this town, and so again, I think we've said it probably, you guys probably tried to hear about it, is just build up that relationship with your banker. So.
Okay, any questions from the audience? Anything that you guys want to know?
Are you guys still awake?
Well, I think that means these guys did a great job covering all the topics that you want to hear about. So let's give Warren and Kendall a big round of applause.
Yeah.
Okay,
So as I said earlier, this is series 1, or I'm sorry, a 3-part series, and this is the first part in the series. So coming up in April, we're going to have Mastering Construction Risk and Safety, and on that panel, we're going to have a couple people from job safety, the job safety environment, some insurance advisors that can help us understand what we need to be aware of as far as risks go. So that's going to be coming up in April, and then on May 29th, that topic is going to be building stronger with smarter growth and safer contracts. And so during that panel, we'll have somebody from the general contracting world and somebody from the legal world that can talk about contracting and how we can build things like escalation clauses into the contracts, as well as probably an operations specialist and an attorney. I already said attorney, yeah. So there we go, we got that. So hopefully you guys will have those on your radar. If you signed up today, you'll be part of our email list, and we'll make sure to get that information out to you. But we'd love feedback, or if you have any comments on future topics you'd like to see, we'd be glad to hear it. So thanks for being here.